able to attend. So I appreciate that. Sorry to interrupt you on that. And I'll just go back here. But Desjardins is truly a pioneer in responsible investing in Quebec and elsewhere in Canada. And I was updated with Deborah that it's not 4.5 billion, but it's actually $7 billion or over $7 billion in responsible investment assets under management. Also, 70% of Desjardins, what they call their Societera funds, which are funds that I use for clients, are the first quartile for 3-year returns. In other words, Societera funds of Desjardins are very profitable and do very well. So without further ado, I'd like to introduce our speaker Deborah DeVos with Desjardins. Deborah is, as I said, a responsible investment specialist with Desjardins. She's also has done many workshops over the years. I've attended several, and I find her to be not just informative, but just well tuned into the whole responsible investment industry. And Deborah, I'll let you continue.
Thank you very much, Doug. So let me share my screen with you. We're going to try and keep this, the me talking very short. I think we'll keep it to about 15, 20 minutes, but I want to make it very clear that if you have any questions, if there are, terminology or issues, environmental, social issues that you'd like me to speak more of, you're very welcome to ask questions. I think you can do it through the chat. You can probably type them in,
right?
Or you can just interrupt me. We're a very small group today, so you can just raise your hand and say hello, and we'll make sure that you're able to participate to the conversation. Alrighty, let's share this, and it's working. Look at that technology. Excellent. Thank you very much, Doug, for having us today. I'm very happy to be here with you for the next half hour and really try to explain and maybe demonstrate how responsible investing can be a driver for change, and how we can really help you as an investor not only make money, but also make your money matter. And I think this is what we want to try to do here. Basically, we've seen it right with COVID, how social issues, social events can have tremendous impact, not only on our lives, but also our communities, our environment, on the markets, and on the companies that we invest in. So I think as investors, it's important to keep in mind what can keep being sources of disruptions on the markets, so that our portfolios are protected, and our portfolios are also able to seize opportunities that arise as the economy transitions. And what's quite interesting with responsible investing is that as we are slowly transitioning towards a 1.5-degree economy, a low carbon economy, you don't actually need to choose between people, planet, and profit. You can actually try to aim for this triple bottom line with this single one investment. The way we do that basically is we try to broaden our horizons. All right, and find the best equipped companies out there. And we broaden our horizons because we go a step further than what traditionally managed investment do. Traditionally, portfolio managers will look into the financial aspect of companies. So they'll look into their balance sheet, they figure out their debt ratio, their equity ratio, and they do a fundamental financial analysis, which is tremendously important, but it would usually stop there. Where responsible investing differs is that we add a layer of understanding, of analysis, of data, and really of knowledge about the companies that we choose to invest in, so that we actually understand their environmental practices, their social practices, and their governance practices as well. So these 3 letters go ESG, and that's going to be my acronym for today. So try to remember it covers environmental, social, and governance issues. And really what we feel, and we're really highly convinced of the fact that the companies that take as good care of their financial side as they do of their environmental side are really very much better equipped to navigate difficult market conditions, to identify and manage risks that could affect the companies in the long term, and also to seize opportunities that arise as the economy transitions towards a greener version of itself. So really, these companies are more resilient, they're more solid, they're more flexible, they have very strong leadership teams, and we feel that adding this ESG analysis really helps us, portfolio manager, make better investment decisions that could service our investors in the long term. So the idea is just that we're not taking anything away from traditionally managed investment, we're adding onto it. It's like this extra layer of knowledge that really enables us to understand what companies do, how they do it, and how they compare with the companies in the same sector, so that we're able to choose the best players in each and every one of them. So we have different strategies that we can use to incorporate these environmental, social, and governance criteria into our decision-making process. And we'll be looking into them one by one so that you can maybe have a more tangible understanding of what this means for a portfolio and how portfolios on the responsible side differ from the traditional side. The first one we use is exclusion filters. Then we actually integrate these ESG criteria into our financial assessment, and we'll look into that in detail. We use thematic impact investing, and this is how we construct the portfolio. And once it's constructed, it's also managed differently when it's a responsible portfolio, because we are active investors and we engage with the companies that we invest in to influence them and have them improve on their ESG practices as well. And as much as we require transparency and disclosure from the companies that we invest in, well, we at Desjardins try to do the same, and we report on our investments on the financial side, of course, but also on the ESG side, so that you have access to impact measurement and you have access to disclosure and reporting on our shareholder engagement efforts as well. All right, let's start with exclusion filters. Exclusion filters, there are very few. As you can see on the screen, we exclude companies that derive a large portion of the revenues from tobacco, from firearms, from nuclear energy, and we also exclude oil and gas companies and pipeline companies from our portfolios. Now, exclusion filters, they're quite easy to show on the screen. They're quite easy to communicate, but they're really hard to manage, and that is why there are only few of them. See, filters, they tend to have this black and white vision of things. And in responsible investing, it's rarely ever black or white. It's really more 50 shades of green, if you will. So we need access to a lot more nuance to be able to form portfolios that are diversified and that can help investors capture growth in many different ways. So really, as much as it's usually the first time we talk about when we talk about responsible investing, I prefer to focus on what's in our funds rather than focusing what's rejected from the funds, basically. And this is where ESG integration comes in. And this is pretty much where the bulk of the work is done by our portfolio managers. There's a tremendous amount of resources, of knowledge, of data treatment, and data intelligence that comes into the ESG integration. What you see on the screen, in each of those boxes, environmental, social, governance, there really are examples of the criteria that we can take into account. There are many more than that. However, not all of them would be used for all the companies that come into our portfolios, because depending on the sector that we're looking into, well, the reality of the business might make the environment side more relevant or the social side more relevant. So you wouldn't compare a mining company with a bank under the same criteria, for example. For one, the environmental aspect of their operations is extremely important, and it's a source of risks and opportunities. For the other one, it might be the social impact of their operations, and maybe cybersecurity or privacy protection that might be more important. So depending on the company that we're looking into, we'll use those criteria that are more material, that are more important to the well-being of the company in the future. Something I like to specify on the environmental side, you can see that climate change is there first. And it might have taken a back seat in 2020 because of COVID-19, where, we've seen a lot more questions about the social issues, the employee treatment, the available of, protection equipment, sick days, and so on. But as things are slowly reverting to normal, climate change has come back up as one of the major sources for disruptions in the market. There are no vaccines for climate change as yet. So it's really important for us to understand what this means for the companies in our portfolios. And it's true that what we want to do is we want to understand the impact of the companies on the environment. So we want to understand how they're contributing to climate change, for example, through their waste production, their greenhouse gas emissions, etc. But we're also very much interested in understanding what climate change means for the companies in our portfolios, because this is where there is a tremendous amount of risks that we need to understand, mitigate, and prevent. We want to invest in those companies that are best prepared to face the changes that climate change mean for them. And we also want to invest in those companies that are actually setting very high objectives for themselves to reduce their impact on the environment and actually put the means into place to meet those objectives. On the social side, we talk a lot about labor standards, because as much as we're located here in Canada and we invest in local companies or in companies located in the US or in Europe, supply chains are located all around the world right now. And so the workers that are tied to the companies that we invest in sometimes are located in regions where workers' rights are not defended with the same energy and the same laws that we're lucky enough to have here. And so one of the conversations that we have with companies in portfolio is to make sure that all stakeholders, including workers along the supply chain, are treated with security, dignity, and respect. On the governance side, again, there are a few examples here. One thing that we look into is board diversity and executive diversity as well. We know that diversity is an added value for any team. It helps them make better decisions, come to better outcomes. We also want diversity because this is actually a better way to be representative of us as minority shareholders. It's also a good way for the company to be representative of their different stakeholders. So their employees, their customer base, their clients, their suppliers, etc. And it's a very good way for them to add value to their proposition. If I want to give you perhaps an example to try and make it more tangible, let's give this example of a semiconductor company. So if me as a portfolio manager, I want to invest in a semiconductor company, semiconductors, by the way, are electronic chips that you'll find in your phone, in your tablet, in the computer you're using right now, in your smart TV, in your vehicle, in your kids' toys. And with the increasing presence of technology in our lives, really the demand for semiconductors is showing no sign of slowing down. It's actually been exponential for some time now, and it still is. So, if you find a company that is financially sound and that makes semiconductors, it might seem like a very good investment opportunity. And you might think, oh yeah, I'll add this into my portfolio. Now, if you add this ESG criteria onto your analysis, what you'll soon find is that making semiconductors, manufacturing them, is a very water-intensive activity. So you need a lot of water to make these chips. And water is a scarce resource. What we know is that by 2030, we might be able to meet only 60% of the global demand for drinking water. And drinking water, by the way, is the same water that is used for any human use. So that's the water that you drink, but it's also the water that grows your crops, and it's the water that is used by industries. And that's pretty much 1% of the total water available on the globe. And so it is a scarce resource. So once you know that, well, you need to factor that into your analysis of that company, because if you want that company to keep growing, that means it will need to keep having a growing access to a scarce resource. And what does it mean for the future? Does it mean that it will be able to grow the way it's intended to? Does it mean that if it wants to keep growing, well, maybe it needs to transport water from elsewhere? Maybe it needs to treat it because the quality is not there. Maybe it needs to be stored or secured somewhere that is not right now planned or being developed. And if you need to develop that other side of the business, does that mean that it'll have an impact on costs? And if it has an impact on costs, will it have an impact on your profits? And as a shareholder, are you willing to take that risk? So really integrating that water component or that environmental issue into your analysis helps you identify risks and helps you identify whether or not you're willing to take that risk, and if that risk is priced in basically into the value of the company. As much as water is right now under the environmental box, it also has social impacts as well. Because that company, that semi-manufacturer company, it doesn't work in a bubble, right? It's in an ecosystem. And so it shares resources with other, with the community, basically where it's located. So if you want the company to keep growing and have an increasing access to resources that it's sharing, it needs to have a social license to operate. A dialogue needs to be put in place with the community to make sure that everyone agrees on to how to use the resources, and to really everything is negotiated so that your objectives can be met in the long term. And on the governance side, it will have an impact as well, because if we want this company to try and lower their water intensity, well, one of the best ways for them to meet the objective is to have it first and foremost written somewhere. So it needs to be part of their policies. And what we could do is we can link that with executive compensation. So basically, if Mr. and Mrs. CEO want their bonuses, well, they better put the means into place to actually meet these water reduction targets so that the company, the employees, the executives, and the community, everyone is actually moving in the same direction and trying to meet those objectives. So basically, as a portfolio manager, once you've done this ESG integration between two similar companies, your choice will likely go to that company that is actually handling environmental, social risks and opportunities and have a sound governance, rather than the one that does not. So really, this is where I see that ESG integration helps us make better decisions. And sometimes we have this thinking that this is, these environmental or social practices are money that the companies are moving away from their core business. And so these are expenses, but they're not. What we see from research is that good environmental, social, and governance practices actually contribute to better results. So companies with lower greenhouse gas emissions in one sector tend to have better financial outcome at the end of the year. Companies with higher female proportion in their employees tend to outperform as well. Companies with lower turnover actually tend to also outperform. So you have examples here of environmental, social, and governance practices that are not expenses. They're actually investments. So it's a way for the company to invest in itself, and it's actually an investment on which they're able to have a return.
Put this.
Is there a question? Okay.
Yeah, maybe Deborah will just pause for a second.
Yeah.
Does anybody have any questions for Deborah? Okay. We'll also ask it when you're finished too, but just wanted to pause there.
Right. So the last strategy that we have actually focuses a lot more on those companies that are actually working on solutions to environmental, social, or governance issues. So you're actually able to find underlying funds that focus, for example, on clean technologies. So you'll have funds investing. We have core funds investing in all sectors, but then in thematic impact investing, you have funds that are a lot more focused towards the management of water, waste management, production of clean energy or energy efficiency. You also have funds that are actually investing in companies tackling social issues such as education, healthcare, financial inclusion, education. And then you have companies that are betting on diversity and women leadership to outperform the markets through better financial productivity. So you really have access to a wide array of options here that will help you as an investor have an impact through the companies that you invest in. So you have an impact through the growing of those green companies, if you will, and you also have an impact through the improvement of companies that might be lighter green. And I say lighter green because we have this perception sometimes that responsible investing is all about investing in those perfect companies. And although we would like to do that, there is no such thing as a perfect company. A company could look very good to me, but you might have an issue with it. Or a company might be very good today, but something happens tomorrow and there's a problem to be dealt with. Really, it's not about investing in perfect companies. It's about the direction of progress, right? It's about agreeing to getting better. And this is just what we do with shareholder engagement. We're active owners of the companies that we invest in. We're active shareholders of those companies. And so we have a say as to how the companies evolve and how they improve in the long term. So we're able to engage in dialogue, we're able to table proposals, and we also vote at shareholder meetings to influence ESG practices. And so we have these three ways of actually putting pressure on company management to have them improve their environmental, social, and governance practices. And the companies do listen to us. Desjardins manages around $400 billion in assets total. We actually deal with, I think it's 9 portfolio managers with, dozens of engagement specialists and ESG specialists as well. So we operate with quite a large clout out there. And so this helps us find the ear of the management of the companies that we invest in. What's quite interesting when you invest in responsible investing, especially if you include some thematic impact funds into your mix, is that you're actually able to see and measure the type of impact that you're able to have through the companies that you invest in. So I mentioned earlier that we can invest in companies that deal with clean energy. So these companies, for example, will help reduce greenhouse gas emissions or create clean energy or treat water or recycle as well. So one way we can do that is we can invest in a company like Trimble. Trimble is a precision agriculture solution company. And what they do is they help farmers actually better manage their machinery. And by doing that, they actually improve and optimize the movement of machinery on their fields. And so they need to move less miles for the same amount of output. So hold on, let me rephrase that. The machinery's movements are optimized in a way that they don't need to go as many miles to have the same impact on the field. So you're actually able to reduce your greenhouse gas emissions. But the other solution that they have is that they're actually able to add and spray water, herbicides, pesticides, and fertilizers only when and where it's needed in the field. So you're actually able to reduce the amount of water used by 20%, but improve the yields of the cultures by 30% because the plants get exactly what they need when they need it. So you have these companies that are actively working on solutions to global problems. And our thinking is that these companies are really companies of the future because they're solving issues that are shared by a tremendous amount of people. And of course, their solution, their product are going to be in a growing demand in the future. I believe that you've seen the Sustainable Development Goals. I'll take just 1 minute to talk about these because you see them on the screen, right? They're huge goals backed by the UN. And the goal is to have them reached by 2030. So really, no poverty, clean water and sanitation for everyone, gender equality, these are huge goals. And what we see increasingly is companies actually using those goals as a roadmap to align their purpose and their profits. And so we're increasingly using these goals as a guide as well for us to see where companies can add value and where can they better contribute to the reaching of their goals to build a better future for everyone in the future. So really looking for those companies who are able to do it in a responsible and a sustainable and in a profitable way for our investors. Summing it up quickly, responsible investing is first and foremost investing in high quality companies. I think I made it clear that we're not taking anything away from traditionally managed portfolios. We're really adding a layer of environmental, social, and governance understanding of the companies and the markets, which helps us make better investment decisions so that you're able to have attractive potential returns. And you're also investing in a way that is closer to your values, closer to your priorities, and that can also help you make a positive impact onto local communities, international communities, and onto the environment. Of course, we have quite a few options available. The best person to guide you in your decision for responsible investing would be Doug here, who was kind enough to have us to talk with you today. He really is the best position to understand your situation, your objectives, and see how this type of solution can help you make money, but also make your money matter. So I'll show my legal notice here because it's needed, and I'll go back to my question screen. Alrighty, is there any questions out there? Is there any aspect that I went too fast and you'd like me to go back on, or do you need specifications on something? Seems like I was crystal clear.
I hope nobody is muted. I'm just concerned about that.
I think people can talk.
Okay. I have a question for you, Deborah.
Yeah, go ahead.
You mentioned relevance when you're investing in companies, and in terms of ESG, environment, social governance, and how some companies are maybe more relevant in one of those areas than others. Would you say that the environmental aspect is going to be the most relevant, generally speaking? And how much or how many companies do you find, maybe generally percentage, what is the most relevant factor of the three of ESG?
So I would say the most relevant factor is pretty much always governance, because although the environmental aspect or the social aspect might vary in sectors, governance is always there. You know, there's always a board, there's always a leadership team, there's always internal policies. And this is usually our way in with any companies that we invest in, namely because we want to make sure that, you know, the leadership team is aware of the E and the S boxes. If the leadership team is not aware, is not taking care of their environmental and social aspects, risks, and opportunities, well, it's likely not a company that we'd want to invest in, unless they're open to us guiding them into incorporating that. But if they're at level 0, it's likely not going to work, because the amount of risk that comes with it is likely too high for us to even want to incorporate that into our portfolios. What's happened though previously is that management team, if they see that we have issues with the way they're handling environmental or social aspects of their operations, will actually keep in touch with us and ask us what they need to do for us to actually invest in them, for us to actually agree to incorporate them into our portfolios. It's happened before.
Interesting.
So, yeah, governance is extremely important, and that is the #1 aspect. The rest follows depending on the sector. And what we see is that climate change, although you might have a tendency to think that it's only in environmental heavy industries or in extractive industries such as mining, what we see is that what happens in places where climate change have great impact is not only reserved to that. So, in Texas, during the month of March, they had a very large, freak climate episode of freezing, and that stopped all of their industries for a few days, if not weeks. And because things were stopped so suddenly, it took them a very long time to repair and restart production. And what we know is that what happens in Texas does not stay in Texas. So we in Quebec, for example, were affected, and we are still affected with the fact that the chemicals that are produced right now only in Texas are not getting to us. So anything that needs glue is right now not being produced in Quebec. Everything is produced with glue. You have doors and windows, you have construction material, you have paint, you have toilet paper rolls need glue. So everything needs glue, and we've had tremendous issues with our supply chain because of that.
Wow.
So even though it doesn't affect your company specifically, it might affect the ecosystem you're in. And so you need to take that into consideration.
Great. Does anybody else have any other, maybe you could stop your screen share, Deborah?
Yeah, sure,
Does
absolutely.
anybody else have questions for Deborah or me in general?
I've got one question actually. Can you comment on the trade-off between the trade-off on returns if you compare, say, one of your environmentally friendly funds, say, an index fund?
Sure. So the truth is there is no real trade-off between a responsible investing fund and a traditionally managed fund. If you look at the research, but even if you look at the returns from the Société Aligned, and Doug will be able to show you those numbers, what you see is that really there is no compromise to be made on performance because those funds are diversified. So they invest in all sectors of the economy. And because, you know, the fundamental analysis, the financial fundamental analysis is done. It's not like we leave it aside because we pursue these green companies. We are looking for companies that are good at doing both, and we're actually able to find them. And as the economy transitions, as governments are regulating to improve and, you know, to meet those Paris Accord targets, what we see is that that transition is going to be producing a lot of, you know, headwinds and tailwinds. So it's going to be really promoting and helping those companies that are already on the greener side. And so this is the bet that we've been taking for some years now, and we're seeing that actually coming to realization. Basically, it's good. Oh,
But in some ways, it could give you a strategic advantage in some ways because you're. But those things, those areas would be kind of the more emerging.
Right, absolutely. And I think the idea is to keep in mind that regulation it's like an ever-tightening ratchet, right? So not companies, but governments are going to keep regulating to meet those Paris Accords and to prevent climate change from having such a tremendous impact onto their economies. So if you look at a carbon tax, for example, that's one example of legislation that could come into effect or that could be strengthened in the future. So you want to invest in those companies that have lower greenhouse gas emissions and companies that are actually working on lowering their carbon footprint. So you need to keep that in mind when you invest in those companies. So when you're comparing two companies of the same sector, well, you might want to go with that company that actually is ahead of legislation, companies that are actively managing that risk and that have actually improved their efficiencies, improved their processes, and that are actually, you know, really managing the risk, but also seeing how they can maybe diversify their energy mix or how they can change things within their business model so that they're ahead of legislation risks.
Thank you.
Deborah, it's kind of you know, when I think of millennials or our younger population who seem to be getting more interested in investing, and I think primarily because of the apps available and the ease of getting into investing in the markets, I find ESG is exciting because not only can young investors who are concerned about the environment and climate change, because they're inheriting, you know, the baby boomers, they're inheriting this world from the baby boomers. But this is an active way, let's just say, to be involved in climate change. You know, albeit a little bit removed, but still, I think it's an exciting opportunity for young people as well as it is for older people too.
Right. There's a question in the chat. So the person is asking if it's possible to be country specific and exclusion filters, for example, exclude China or express a preference for particular countries. So in the solutions that we have right now, these are very diversified and global portfolios. So, you know, as an investor, if you'd like to be extremely specific as to what you want or don't want, then you probably have to go with making your own portfolio and buying your own stocks and bonds, which is probably not what we'd go for, because it does require quite a bit of understanding and knowledge about the markets. You know, I mentioned earlier that there's no perfect company. It's also likely that there's no perfect responsible investment fund, because they're very diversified funds. So, you know, in an equity fund, 100% equity fund, you'll have probably 600 different companies in there. So there might be one or two companies that, you know, you might frown a bit and say, oh my God, I'm not sure I want this company in my fund. And understandably, you know, we have different values, we have different priorities. And so we can't 100% agree with everything, but I would invite you to maybe take a step back and look at the bigger picture, because if you don't like one or two companies, it also means that, you know, over 500 of them are actually pretty good, and this is where you want to go. And maybe keep in mind as well that one way that we have an impact is with the dialogue that we hold with the companies in our portfolios. And those companies that you might frown about might be the companies that we are actively engaged with, so that they can improve their ESG practices. If we were to divest from those companies, then we wouldn't be shareholders anymore. And we might not have access, privileged access like we do now, to the board and to the executives to actually make our voices heard and have them change their ways of doing.
So I think what we'll do is, and thank you for that question. I think what we'll do is end our webinar. I personally would love to talk about this a lot longer, but again, in respect to everybody's schedule and time, I would like to conclude. If you have further questions, you can certainly contact me. You can contact me by phone or email. I also would like to thank Deborah. That was an excellent presentation, Deborah. And I think that, you know, it's enlightened me again, but it's also hopefully enlightened some of our participants here today. I also wanted to just conclude here by bringing over some resources that are available. And these are, there's several things that I pulled out of some of the Desjardins material. And I can forward either all of these or several, one or two of these resources to you. One of the ones that I like a lot is this 2020 Responsible Investing Report. Also, if you would like to talk more about this or other financial concerns, we can always set up a time to meet either by phone or by Zoom. And if you have concerns or questions that I cannot answer, Desjardins is a great resource for me to find the answers for you. And lastly, I'd like to just put in a little plug, a little advertisement for our last webinar for the spring, which is in 2 weeks on May 25th. And it's about tax and your retirement plan. So thanks, Deborah, for joining us today. I really enjoyed it. I'm really happy I remembered to record it as well. And if anybody else has any other questions, I will be staying on for a few more minutes. So for those of you that need to go, though, thanks for attending.
You're welcome, Doug. It was a pleasure. Thank you for your questions, everyone.
Yeah, those were great questions. And you know, one of the things that I really think is so important here is that just like people, companies aren't perfect, and the ones that have great intentions sometimes fall by the wayside. But as you described, the lighter green companies, I think, made so much sense, and you know, having some responsibility to trend towards to be a better, you know, company in terms of ESG is a big deal. But it's, you know, it's impossible to be 100% perfect all the time, that's for sure. So, okay, well, thank you everybody for attending. I really enjoyed it today. I hope you enjoyed it as well, and hope to see you again soon. Bye-bye.
Bye.